Hey guys, Missy and Jason here with the Improta Team.
So today, many people are afraid that the real estate market is starting to look a lot like it did in 2006. In fact, at one of our showings recently, it was like groups of people waiting out in the driveway and a group in the house, and there was this sort of fervor.
Writing offers on car trunks?
Literally, it was crazy.
Except we DocuSign now?
It's starting to feel a lot like that, just prior to the housing crash that happened in 2008. One of the factors that they're pointing to is the availability of mortgage money. Recent articles about the availability of low down payment loans, down payment assistance programs are causing a fear that we're returning back to the bad habits we saw 15 years ago. We'd like to try to alleviate those concerns for you guys.
Several times a year, the Mortgage Bankers Association releases an index titled the Mortgage Credit Availability Index. Basically, the index determines how easy it is to get a mortgage. The higher the index, the more available mortgage credit becomes. To give you an idea, the index stood at about 400 in 2004. Mortgage credit became even more available as the housing market heated up, and then the index passed 850 in 2006.
Skyrocketed.
When the real estate market crashed, so did the MCAI. It went below 100, as mortgage money became almost impossible to secure. Thankfully, lending standards have eased somewhat since. The index, however, is still below 150, which is about 1/6 of what it was in 2006.
So why did the index rage out of control during the housing bubble? Well, the main reason was the availability of loans with extremely weak lending standards. To keep up with demand in 2006, many of the mortgage lenders offered loans that put little emphasis on the eligibility of the borrower.
Basically a heartbeat.
Right. Lenders were approving loans without going through a verification process to confirm if the borrower would likely be able to even repay back the loan. They were practically just giving the money away to these borrowers. Today, lending standards are much tighter. The risky loans given at that time are extremely rare today, primarily because lending standards have drastically improved.
Yeah. During the housing boom, many mortgages were written for borrowers with a FICO score under 620. In today's market, lenders are way more cautious about lower credit scores like that. There are definitely still loan programs that allow a 620 score. However, lending institutions overall are much more attentive about measuring risk when approving loans. In 2006, mortgage entities originated $376 billion in loans for purchasers with a score under 620. Last year, that number was only $74 billion.
So the bottom line, in 2006, lending standards were obviously much more relaxed with little evaluation done to measure a borrower's potential to repay their loan. And today, the standards are much tighter, and the risk is reduced for both lenders and borrowers. These are two very different housing markets, so what we feel like is there's no need to panic over today's lending standards.
Definitely. And if you guys want to know more about how this will play out in your particular scenario, please feel free to reach out to us and we will walk you through it.